MDTA Finance Committee meeting this morning. I hereby call the meeting of the Finance Committee to order at 9 a.m. Due to the COVID-19 pandemic and in accordance with the live streaming law, this meeting is being conducted via video conference and being live streamed on the MDTA Finance Committee webpage. All members will have their video active during the entirety of the meeting. I ask that anyone who is presenting or answering a question to please turn your video and audio on when speaking. When you're done, please turn your video off and put your audio on mute. To minimize background noise during the call, I would ask that everyone on the line please mute your phones except when speaking. There are no members of the public nor elected officials and no members of the media pre-registered to speak at today's meeting. At this time, we will move on to agenda item number 1, the approval of the minutes. Everyone have a copy of the minutes and had time to read them. If so, is there approval? Is there a motion to approve the minutes?
So moved.
So moved. Second.
Okay, we have a motion from Member Rosen, second by Member Carroll. All those in favor?
Aye.
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 Opposed? Motion is approved. Thank you. We'll now move on to item number 2 on the agenda, debt policy and review of MDTA's debt policy. And we have Alan and Dana to present today. Good morning.
Good morning, members. Alan, he's on vacation this week, so he may not join us. And I don't see Dana yet, but I'll go ahead and cover the item. This is an annual review of the debt policy. It's a requirement of the board policy. We have reviewed the policy and are currently not recommending any changes to it. The debt policy includes some legal requirements within the Maryland state law and the trust agreement, and some board directives, which helps us ensure financial strength. These guidelines, oh, there's Dana. Support good credit quality and access to capital markets at the lowest possible financing rates. Dana, you want to take over?
Yes.
Thank you.
Good morning.
Good morning. Good morning, Dana.
Okay. The debt policy is to be reviewed annually, followed by a request for a recommendation to present to the full board for approval. The policy was reviewed by internal staff and our financial advisory firm, and no changes are currently recommended. I will take a few minutes to highlight some of the key elements of the policy listed in the table and their importance to credit quality. The policy's established guidelines are specific to the issuing and managing of debt under the bond program. These guidelines incorporate specific financial targets. For example, the unrestricted cash target. This is a policy requirement to maintain a minimum of $350 million in unrestricted cash reserves. This demonstrates the ability to withstand downward shifts in revenue or unforeseen capital expenditures. The debt service coverage target. This is a policy requirement to maintain a minimum of 2 times debt service coverage, which demonstrates the ability to meet annual debt service costs. Both targets provide a cushion of safety, which is looked at favorably by credit ratings agencies. and reflect strong financial and operational performance. Which takes us to the policy's credit ratings goal. The MDTA is in compliance with maintaining the highest investment grade credit ratings in the total bond sector. In 2021, a AA rating was affirmed by Fitch and a AA2 rating by Moody's, both with a stable outlook. Now, with regard to the debt limit, there is a statutory limit on the level of outstanding bond debt, and that limit is $3 billion. MDTA's outstanding debt has stayed below the debt limit. In conclusion, the debt policy is a strategic document which continues to support MDTA's credit quality and access to capital markets at the lowest possible financing rates. I will now pause for any questions.
Any questions from any members? Okay. All right, thank you. Do you have more to add?
I would like the Finance Committee's recommendation to move forward the debt policy to the full board for approval.
Okay, thank you, Dana, very much.
All right.
Any other comments from any board members? Is there a motion to advance this item to the full board for approval?
So moved, Member Carroll.
Okay, we have a motion from Member Carroll. Is there a second?
Member Ardinger, I'll second.
Okay, we have the motion and a second. Is there any further discussion?
No further discussion.
None? Okay. All in favor?
Aye.
Aye.
Opposed? Okay. Thank you. This motion is carried to the full board. Thank you. Okay, we will move on to item number 3. Item number 3 is an update, and I guess Clayton, will you be presenting today?
Thank you. Yes, this is Clayton Dewig. I'm the investment administrator for the agency. And I think I'm joined by David Calvert of PFM. David, if you're on the line.
Yes, I am on. Yes, I am.
Okay. David will cover the
Hi,
first
David,
few
welcome.
slides, and then I'll take over from there to go through the portfolio and the position.
Okay.
Thank you, David.
Very good. Thank you. So the last quarter is basically highlight a continuation of the current themes. Short-term interest rates continue to be anchored by the Federal Reserve policies, and the Federal Reserve has basically reiterated that they're going to keep a low interest rate environment of 0 to 25 basis points for at least the foreseeable future, which includes the current year as well as next year. This has resulted in money market yields, the Maryland LGIP, as well as other overnight rates to be below 5 basis points, so 0.05%. Overall, we've seen a downward shift in yields. We saw a spring rise, but since March 31st, rates in the 5-year area declined by about 5 basis points, and then rates in the 10-year area declined by 27 basis points. And that was through June 30th. Since June 30th, rates have continued their downward slide, and we actually saw the 5-year reach a low about 66 basis points just earlier this week, but in the last 2 days has rebounded up to 79 basis points. So we continue to see some oscillation in fixed income investments and fixed income yields, all based upon the current economic news. The economy is humming along. In fact, during the second quarter, GDP growth was 6.5%. That was preceded by 6.4% GDP growth during the first quarter. And if things continue to hold up as they are, it would probably represent the strongest growth in the U.S. economy over 2 decades. The unemployment rate picture continues to not be as rosy as pre-pandemic levels, but we're continuing to make great strides. For the month of July, the unemployment rate declined from 5.9% down to 5.4%, so a 0.5% improvement, which is quite dramatic. And that was driven based upon a large number of new jobs that were added during the month. In fact, 943,000, just shy of 1 million jobs, were added in just a single month alone. What we're seeing in the economy is a continuation of basically a dislocation of jobs as well as employees. And what I mean by that is that there are more jobs that are needed to be filled than the number of employees that are looking for jobs at those current levels. So what this necessarily represents is that there's a mismatch of skill sets in terms of there are professional jobs that they're seeking employees, maybe they aren't local or maybe they're not really available, as well as individuals that are maybe on the lower spectrum of the wage scale, earning less than $10 or $15 an hour, and they don't necessarily want those jobs because they're getting supplemental enhanced unemployment insurance benefits from the federal government. Those benefits expire September 1st, so we may see a continued drive and continuing improvement in the unemployment picture as those individuals are willing to accept jobs at those lower wages. On the next slide, in regards to Federal Reserve policy, the Federal Reserve continues to basically try to balance a economy in terms of making sure that there is a robust economy as well as inflation. If you look at some of the inflation gauges, it appears that they are running a little hot. In fact, the PCE, or the Personal Consumption Expenditure Index, rose by 4% in June, while the core PCE, excluding food and energy, increased by 3.5%. For a very long period of time, almost a decade, the Federal Reserve was basically touting the fact that if inflation ran hot, maybe around 2% or above 2%, that they would be poised to raise rates. In 2020, Jerome Powell and the other federal officials basically said that that particular policy was essentially too arbitrary and too static. So that they said that instead of basically having a target of 2% where they would start raising rates, it would be more of a policy of, okay, are we balancing the effects of growth as well as inflation? So most policy officials are now basically saying those high inflation readings are essentially transitory. And what I mean by that is that we saw decreases in prices due to the pandemic in 2020. So when you're comparing them against last year's numbers, it appears high. But if you smooth them out over the last 2 years, we're running at an inflation level in the 2 to 2.5% range. So there's not much of a cause for concern from an inflation perspective by the Federal Reserve. The other thing that the Federal Reserve is doing is that it's increasing its holdings of Treasury and mortgage-backed securities by an order of $120 billion per month. So they're adding to their balance sheet. Essentially, they're printing additional money to interject in the economy. So before we see any increase in short-term overnight rates, the major policy change that would have to occur is that the Federal Reserve would have to slow down those purchases and even maybe stop those purchases. So that might be a 2 or 3 mean progression in order for them to cut back $120 billion down to zero. And they haven't indicated any immediate plans to do so in the next meeting or so. So therefore, we probably won't see rates rise anytime in the immediate future in 2021 or even 2022. There is some speculation that in the early part of 2023, the Federal Reserve might raise rates by a quarter or 50 basis points, but that is pretty far into the future from today's date. Clayton?
Thank you very much, David. So moving on to slide 4, I wanted to highlight a couple of items here. I think on the top left, the pie chart, what we notice is the significant allocation for the portfolios to the agency, Treasury, money market, mutual fund, and cash sectors. And this is obviously very conservatively positioned, but it's also a function of the opportunities that we're seeing in the market. where there are really not very many relative value opportunities in other sectors, such as the supranationals, the commercial paper, and the municipals. And we'll come back to this a little bit later in the discussion. I think the other thing that is helpful to recognize is in the bottom left, under the purchases column, third column from the left there, we had significant purchases in commercial paper and supranationals during the second quarter, and those were a function of the bond financing that was completed early in the second quarter. And so we took those bond proceeds, conservatively invested them in commercial paper and supranational instruments, and did that as we moved on to slide 5, made those investments on a match funding basis. So what slide 5 talks about is the strategy for the portfolios. You may remember there are basically two strategies. One is a match funding strategy, the other is total return. And so as we raised the bond proceeds in the second quarter, we took those proceeds and put them effectively in a capital account type of investment, very short-term match funding type structure where we invest the proceeds as the spending is expected to occur. The other thing to highlight here on slide 5 is the difference in total return strategies between the general and the M&O accounts. The general remains in a very short duration, 3-year max maturity or duration strategy. The M&O reserve is a much longer duration strategy and will go out to 7 years. We are in the process continuing to transition that, and but this highlights the differences in the two strategies on a duration basis. Moving on to slide 6, what we really like to highlight on this slide, and the reason we continue to show it to you, is because we see up at the top the income return, the stability of the income return in the fixed income space. Although certainly yields have declined and therefore the coupon income has declined over the years, what we see in terms of volatility on the price return is pretty impressive, I guess I should say, in that there is interest rate volatility, as David mentioned earlier, and we expect with rates so low there to perhaps be some more volatility on a going forward basis. So we may see some total returns that are challenged going forward because we do have low income, low coupon bonds in the portfolios, and there could be significant potential for negative price returns. With that, we'll move to slide 7 and go through the performance. The general account here on slide 7 shows the monthly returns of both the portfolio and the benchmark in blue, the portfolio in yellow. Another way to see this is on slide 8. You know, we like to show slide 7 because, again, it shows the volatility of the returns in this space, and that's important to recognize. But on slide 8, what we like to focus on, one of the things we like to focus on is the longer term returns. And so over the 12-month period for the general account, you know, we're doing quite a bit better than the index, although 10 basis points, some might argue whether that's a lot better, but on a relative basis in fixed income, that's meaningful, although there have been some challenges on the 6 and 3-month periods. Over on the bottom right of that table, in the yellow and the blue, the very bottom right line, you'll notice that the portfolio was running right at the expected duration of the benchmark. So we're 100% at target there. And that's been fairly consistent throughout the past 12 months. Moving on to the M&O account on slide 9. Again, you'll notice as we have been transitioning to a longer duration strategy, you'll notice the volatility of the current index, which is in yellow or orange. Lots of up and downs there. The portfolio in the blue has experienced less volatility, but still volatility. And so to some extent, it's helped us quite a bit during this transition to be cautious and prudent in the investment and extension of the duration. Slide 10 highlights the longer term performance, 12 months and 6 and 3. 12-month basis, we look quite a bit better than this new index, and even better than the former index, that 3-year duration index. So that's interesting, and it's been rewarding in a way to be cautious. So I would emphasize that. As we look at the bottom right of this table, we notice that the portfolio is at 53% of the target. And so I would say, with the trade completed last week, we are just over 60% of the target duration. 60% represents about 2/3 of the way to where we want to be. And maybe it might help to shift over to slide 12, the bottom chart and table on slide 12, where we see the maturity distribution for the M&O account. We would expect over the next 2 to 3 months to complete this transition, and so it would take probably just under a year to transition the M&O portfolio to the new index, to the new strategy. As I mentioned, we did a trade last week of about $3.5 million. So if we add that $3.5 million to the 5 to 10 bucket, we're at about $17 million in that 5 to 10 year bucket. Actually, it's the 5 to 15 year bucket now, but we expect 2/3 of the portfolio, the M&O portfolio, or about $34 million to be invested in the 5 to 15 year maturity bucket, if that makes sense. Maybe I should pause for any questions to this point. No? Okay. So slide 11, sorry to go back and forth, but I think it's helpful sometimes to be a little bit, to put it in perspective across the slides. But slide 11 shows the allocation by maturity for the aggregate assets, all of the assets, the $942 million of assets of the agency. You'll see on this slide 11 that the 0 to 1 year bucket has gotten a significant increase in exposure during the course of the quarter. Again, that's due to the bond financing that happened early in the quarter, the investment of those assets in commercial paper and supranationals, and we would expect as that capital gets spent, this to drop materially over the next, at the time, 12 to 15 months. Moving on to slide 12, we'll see the maturity structure of the general account. The general account, not a lot of changes, a little bit of shift between the 3 to 4 and 4 to 5 year maturity buckets. But what's important here is that the duration of this portfolio, as we highlighted earlier, is at 100% of target. So that's the important takeaway. Even though there are shifts within the maturity buckets, we want to make sure that the duration target, that we remain consistent to the duration target. Again, at the bottom of 12, we see the M&O portfolio. We've made material progress there in shifting, transitioning to that longer duration. Again, expect by the end of, I would say, certainly by the end of November, which is a year, that we'll have fully transitioned and be up to speed on the new duration target. If there are no comments or questions, we'll move on to slide 13 and 14. Actually, 13 and 14 are the compliance report. And, you know, what I really like to emphasize here every quarter with you, with your members, is that we are in compliance with the policy, and that's important, and it's exciting to be able to say that. And we adhere to the rules and the policy guidelines strictly, and see no issues going forward. Up at the top, the accounts match funding again, and the total return strategies, maturities are shown. We're in compliance there. I think we do a breakdown by issuer on this page and the next page. And you'll see that exposure increase in commercial paper at the bottom of page 14. Following on this are supplemental slides for your information. I don't know if there is anything I would highlight here, but certainly if there are any questions, please feel free to let me know. We do include on 16 the dealer trade allocation. I guess one thing to highlight here is that we see the proportion of trades to Wells Fargo has decreased over the past trailing 12 months, and that's I guess that's to say that some of the other dealers are getting much more competitive when we're out shopping for bonds, and that's important to see that competition. It's important to see that that Wells Fargo is not dominating the market. With that, if there are no
Clayton.
questions, yes.
Are there any questions from any members?
Yeah, I said this member has just a quick question in regard to our transition to the long dated bonds in that portfolio. Do you have an expectation that when rates start to rise, as you mentioned, perhaps in 23, that's going to help us? Will that flatten the yield curve? Do you think, or do you think that's going to go the other way? I know the second you say it, it's not going to happen, but what do you think?
Yeah, I hesitate. I do hesitate to say anything. You know, Alan is always cognizant of the fact that we can't predict rates. We didn't feel like rates would back up so fast as they have. You know, I guess the first 3 months of the year, and that they would again drop the next 3 months. Yeah, you could get a curve flattening. I think as we're out looking in the market for bonds that bear a coupon, you know, we'll be insured against rate backups to some extent by the coupon that's coming in. I'm not sure if that helps with your question.
Yeah, and this is Dave Calvert. One of the advantages for a longer term strategy is just looking at the shape of the yield curve. In terms of what I mean by that is that by going out longer, you're putting funds and taking advantage of that steeply sloped yield curve. And after 1, after 2, after 3 years, instead of it being a 7-year investment, it's a 4-year investment. So you have to actually look at the change in yields on the 4-year piece as opposed to where we originally bought the security. So there is definitely some credence of saying, okay, by having this longer term strategy, you're actually going to be generating what's referred to as roll down within the industry and help contribute positively to the return. And when the Federal Reserve is talking about raising rates, that's really on the short end of the market. So in terms of overnight investments, less than 1-year investments, and that speaks, even though it might be 2 or 3 years out, in terms of actually being implemented, it's already being factored into those longer term yields in the 5 to 15-year area. So there's not necessarily a direct correlation saying that, okay, the Federal Reserve starts raising rates in 2023, then that means 7-year investments are going to be 100 basis points higher, which then just goes to Alan's train of thought, Clayton's train of thought, that you can't necessarily guess or overthink the market because you have no, not necessarily an idea that like, okay, there's going to be a direct correlation. And one other thing that PFM looks at is that we look at where U.S. yields are relative to the rest of the world. And if you actually look in Europe for 2-year investments, anywhere between Switzerland, yields are negative 78 basis points to a country that is much lower in credit quality, for example, Spain and Italy, and their rates are negative 37 basis points and negative 51 basis points. Even if you go out 10 years, German yields are at negative 21 basis points. So it's not just in the U.S. where rates are low. In fact, if you look at U.S. relative to the rest of the world, U.S. rates are actually pretty high. So there's a lot, not only in the U.S. that has to occur, but also the rest of the world in order to push yields much higher.
Thank you.
I do have a question here, Member Von Paris. Our shift to supranationals, that's a significant investment there. What is the strategy behind that? Because we were kind of sitting, we reduced that quite a bit, and then now we're coming back. Not to the extent where we were, and far below our requirement.
Yeah, so the thought there was, again, the bond proceeds that were raised in early April, we wanted to park those somewhere for a period of, at the time, it was about 15 months. So we took part of the proceeds and found relative value in the supranational space. And so that's what it was. Relative to treasuries, relative to agencies, we saw some value in supranationals. Had, to your point about the policy constraint, a lot of room there, and so took that opportunity to add some positioning. And the same for the commercial paper.
And given the timing of the bonds, supranationals generally have greater availability during the spring as opposed to the fall, so that bonds were times where there may be a little bit more additional supply of supranationals than in other parts of the year as well. And supranationals compared to U.S. Treasuries and GSE debt, there's much more of a limited supply. So you have to sort of time the availability of the investments when they are actually looking to issue bonds.
Thank you. Any other questions? All right. Well, thank you, gentlemen, for your presentation. Appreciate it very much. We will move on to item number 4 on the agenda, the investment policy. And Clayton, you're still on. And
Thank you.
This will be an approval item. Thank you.
Yes, thank you for your time. Yeah, we are requesting recommendation of the Finance Committee to present to the full board for approval of the proposed changes. This constitutes this memo and supporting document constitutes the annual review of the investment policy, and so that's why we are requesting your approval for the changes that are proposed. So I would say I would open with help or reminder that prior to the 2020 bond financing, so this happened probably 14 or 15 months ago, there was a proposal recommendation and approval by your board to insert a few amendments into the trust agreement. One of the amendments that was inserted was a springing amendment, and the springing amendment, basically what a springing amendment does is it will trigger once more than 50% of bondholders vote in favor of the amendment. If we look at the memo, page 2 of this memo, at the top, so maybe in summary, what we're asking your recommendation for is to include municipal bonds in the second highest rating category that are rated by at least one rating agency. And so the amendment that was inserted into the trust agreement in the spring of 2020 and the bond financing that occurred then, as well as the bond financing that occurred this year, this spring, led to the situation where the amendment has actually sprung. In other words, a majority of bondholders have voted in favor of the changes, this amendment change to the trust agreement. So in the second item on page 2 of the memo, we again see that the trust agreement changed from the highest rating category by at least 2 rating agencies, and it now reads, at the time of purchase, at least the second highest rating category by at least one of the rating agencies. So again, This has been approved by your board. It is now part and parcel of the trust agreement via the 9th and 10th supplemental. What's happened as this has sprung is that the trust agreement leads the investment policy. So the investment policy is not giving us this latitude. And so what we want to do today, and with your approval and recommendation, and assuming there is approval with the board, we want to bring these two documents in line with each other. That is the investment policy and the trust agreement. So the current policy, again, says the highest rating category by at least 2 rating agencies. And we're proposing to bring this into line with the trust agreement, at least the second highest rating category by at least 1 of the rating agencies. So
Excuse me 1 second. Clayton, excuse me, it's difficult to hear you a little bit. Is there any way?
I'm sorry. Yep. Does this help? Is this okay?
A little bit.
Okay.
Yes, thank you.
Forgive me, my microphone, the laptop microphone is having some challenges today, so I hope
I'm sorry,
this is better.
I feel bad to
there
interrupt.
anything?
I feel bad too.
Not at all, not at all. In fact, I was going to say, if you'd like me to go back, tell me how far, and I can certainly do so. No?
Okay.
Okay.
Seems
So
like we're okay.
again, we're trying to bring the investment policy up to speed with the trust agreement. This will do a couple of things. First of all, it provides us some flexibility in the event that we have a position in the portfolio that gets downgraded to the second highest rating category. In other words, we would not be forced sellers. We would have the latitude to hold it even to maturity if we deem it wise and prudent. The second thing that it does is it gives us a broader opportunity set. So within the municipal universe, there are more than 20,000 obligors or issuers. As it happens now with our limitation to the highest rating category, we're only able to take advantage of about the top 5% of that universe. With an expansion to issues that are in the second highest rating category, we would be able to take advantage of almost 50% of the universe. That said, there are certainly other qualifiers that go into our decision making for investment. They're not specified in the policy, but we are fairly selective, actually very selective, and so. This gives us, in the right circumstance, the opportunity to take advantage of a little bit better yield, a little bit of better spread, and enhance the returns of the portfolio. The second item regards notifications when there is a downgrade. And as I understand it, the practice of the agency has been to notify your finance committee and your board when there is a downgrade. And what we're attempting to do here with this policy revision is just to formalize that notification process. And so this is going to require us in the policy to notify you in the event there is ever a downgrade in the portfolio. I think Alan has mentioned that there have been 2. One were the federal agencies, Fannie Mae, Freddie Mac during the financial crisis. And then there was another one. But notification has been and will continue to be given. Again, this formalizes that notification process, and so that's why it's in the policy. If there are no other questions.
Okay. Any questions from any members? Okay, I think thank you very much, Clayton, for your presentation today and others. And we will, is there a motion to approve this item and advance it to the full board for approval?
So moved.
We have a motion. Is there a second?
Member Artinger, I'll second.
Okay, motion from Member Rosen, second by Member Artinger. Any further discussion? All those in favor?
Aye.
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 Okay, this motion is approved. Thank you.
Thank you,
And thank you for Clayton for your presentation.
certainly.
We'll move on to item number 5, and David Green will present today. Good morning, David.
Good morning. How is everyone today? My name is David Green. I'm with the Office of Policy, Innovation, and Performance. And this item represents an update to the Finance Committee on the request to recommend to the Board for the Board of Public Works approval to transfer the former Maryland House Travel Plaza mural scene, which depicts Francis Scott Key in front of the U.S. flag, to the Maryland Commission on Artistic Property of the Maryland State Archives. Pennsylvania artist William A. Smith was commissioned to create several murals for the Maryland House Travel Plaza. The murals depicting significant individuals and events of Maryland and U.S. history were installed in the lobby of the Maryland House on April 2nd, 1968. The murals, originally 3 individual sections, included one section located on the first floor of the former Maryland House, which was removed from the building in March 1989, and 2 other sections located on the second floor. The mural on the agenda item today was formerly on the second floor of the old Maryland House. Those murals were removed in September 2012 as part of the Travel Plaza's redevelopment P3 project and cleaned and properly stored. The murals were appraised by Painting Conservator in December 2013, and all along we've been updating the family on the disposition of the mural panels. Recipients of 7 of the 8 murals previously approved for disposition by the BPW are the Baltimore Civil War Museum, Civic Works, the Clifton Museum, and the Maryland Commission on Artistic Property. And with that, if there are any questions, our request is to recommend that the MDTA board continue with the preparation of the BPW item for the transfer of the remaining panel to the Maryland Commission on Artistic Property.
Okay, thank you, David.
Sorry.
Are there any questions?
Sorry, Mike.
Member Rosen, sorry. Member Rosen, do you have a question?
I do not have a question.
Okay, I'm sorry. Any comments or questions or anything at this point from any board members? Mr. Green? Okay. Is there a motion to advance this item to the full board for approval?
So moved. Member Carroll.
Is there a second?
Member Artinger, I'll second.
Okay. Any further discussion? Okay. All those in favor?
Aye.
Aye.
Aye. Aye.
Opposed? Okay. This motion is passed. Thank you very much. And Mr. Green, thank you for your presentation today. And it's good to see that this treasure is being preserved. So
Yes.
thank you.
Thank you.
Thank you very much.
You're welcome.
Okay, we will move on to the final item on the agenda. It is we've already handled all the items requiring approval, and the last item is an update on the asset management of the organization, and James Harkness will present. Good morning, James. Hi, James. How are you?
Hi, good morning. Thank you, everyone, for the opportunity to present today. This is an update item on the Office of Engineering asset management efforts that we've undertaken. This presentation was presented to the Capital Committee in June, and we're now here today to provide you with the same information. For the record, my name is James Harkness. I'm the acting chief engineer for MDTA in the Office of Engineering and Construction. So the Office of Engineering and Construction created a asset management discipline approximately 2 years ago, and that effort was to centralize and create a systems approach to asset management within the Office of Engineering and Construction. Previously, many of the disciplines had undertaken independent efforts in the realm of asset management, some to varying degrees. And so we created this discipline to sort of unify that approach across OEC and start to implement tools that would make the deployment of asset management easier for the Office of Engineering and Construction. So within that discipline, we have John Privet, he's our manager, and we have Steve Martin, who is the asset management coordinator, along with the team of their consultants. They are responsible for the information that I'm presenting here today. So moving to slide 2, this is the objectives of the asset management. So I guess to start, I want to provide the definition of asset management, which is the strategic and systematic process of operating, maintaining, and then expanding resources throughout their life cycle. And we would just add that we are attempting to do that in a fiscally responsible manner. So some of the objectives that we laid out in OEC was to use asset management to streamline information sharing across the organization. So within OEC itself, between engineering and construction, but then also sharing that information with others in the organization, particularly operations. We also look to have an inventory of all our assets to know what we have and where it is and what condition it's in. And then we want to also prioritize and have the ability to make good decisions about maintaining and eventually replacing those assets. Through those efficiencies, we hope to reduce costs, make informed project decisions, and then ultimately we want to identify risks and make those known to us. So we'll move on to the next slide. This obviously asset management is largely based in data and a lot of data, and so we needed a big tool to handle all that data. So one of the first efforts that the asset management discipline undertook was an IT project. So in coordination with our IT group, we worked on an enterprise GIS system. That GIS system would allow us to create an asset registry. And formerly, we had utilized the Google Earth platform, which was basically a viewer, but it was not fitting for a true asset management program or system. So we went with a modern GIS, so ArcGIS Enterprise, and we've set that up, and it's a robust system that's scalable, so it can grow as we're ready to grow. We have virtual servers in the back end. That means that data is accessible in the network, outside of the network, and also remotely accessible. We can go to the next slide now. One of the products that I mentioned was Google Earth. Well, we're transitioning out of Google Earth and going to move the data over into this GIS viewer system. So we're not yet ready. We're still in the test phase, but you can sort of see an example of that system. And this happens to be our electrical assets at the Key Bridge. And so this is one of the systems that essentially users can get in, see the assets that are there, and then they can turn layers on and off to see what they need to see, bring in references, and essentially then drill down to get some details on those individual assets. And one thing that about this viewer is It will be, again, mobile, so you can access this data through a tablet, through a laptop with a connection, or your cell phone. Another good feature about this is that we're building this tool, and it's kind of that inset picture on the right. And essentially, when you are in the field and you notice something is wrong or needs attention, you essentially can create a report right from the field. You can drop a pin, you can click on a specific asset and enter information about what you found. And so essentially it's in real time, and we can get the information to the data owner to react to it. Moving to the next slide, we go through the inventory and condition assessment. So again, back to data, it's essentially the currency of asset management. So we need to know, again, what we have, where it is, and then hopefully have critical information about that. So we have to do inventories so we can assess the model, the manufacturer, its connections, its condition. We are undertaking efforts now in many of the disciplines in OEC to go to the field and actually inventory all of our assets, make sure we have an up-to-date inventory, and then also perform condition assessments so we know what condition these assets are in. So whether they're poor or whether they're in great condition. We are working through that right now, and I have a couple of examples of that. So this example is for our facilities, our buildings. We have this asset viewer is showing, I think the picture on the screen is should be the Bay Bridge, and it essentially pulls up some quick data for you. It shows you that we have 7 buildings in that inventory. We've completed 5 assessments. We have some damage reporting. So essentially, if they find something, it comes up as a damage report. It's a quick way to go through it, but it's also important because it's taking all of those assets, quantifying them, and then essentially this effort is to report out to TSO so that TSO has a full complete picture of the facility assets for each TBU. So we're part of that. So this initially started as an Excel-based report that we started working with 2 years ago, and we, through the asset management group, were able to create a mobile application, a tool where you could just enter your information directly out in the field on your tablet through GIS, and then we automated that to report out in the format that TSO wanted. So our initial effort, when it was in Excel, took about 2 weeks to compile the results and to create the report out. And this past year, reporting out now through this application took us 2 hours. So that was pretty impressive turnaround there. So moving on to the next slide, we have another one of our facility assets, and this is a slightly different effort. This is to take our Maximo system, our maintenance management system, Maximo, and we're trying to integrate our GIS model, which is a vertical model, and integrate that with the Maximo system that maintenance uses for maintaining our building facilities systems. So we created these building models, and what you can see on the right here in the background is a aerial view of the building, again with its assets overlaid, and then this inset is the asset viewer. So you click down into this. This example happens to be for the maintenance building, and it's showing I believe it's a generator inside this room. So you've clicked into here, and then from that they can drill down and get very detailed information about any kind of preventative maintenance, any past work orders that they've performed on it, and so that they can get a history of the work that they performed on these right from the field. Okay, moving on to the next one. We have one of our more mature disciplines was the structures discipline. So they've had reporting requirements on the condition of bridge structures through federal highway for quite some time. So they as a discipline has been furthest along on this. So we are now expanding and really growing their capabilities. So one of the things that we've recently done is took the effort to inventory and assess all of the low-level lights. So all the interchange lighting, the low-level interchange lighting. And so in the picture on the screen there, you can see little icons indicating the location of every light pole at this interchange. This is 695 and 995. And then in the inset on the right, that's essentially the details about that pole. So they capture a photo, they capture notes, they rated the condition as good. And then that information is, again, it's mobile, it's available to operations and to engineering as well to share that information. And then we're also working on the structures group for ancillary structures, and those type of structures are sign structures, for instance. So in the inset, you'll see a photo of a sign structure, so they can condition those and provide information about that information. So we can now move on to the next slide. So the last examples were sort of detailed, very in the weeds on particular assets, and then now we'll kind of take a larger, higher level view of some of the GIS efforts. So this is what we're calling a project tracker. Essentially, we are entering a lot of project information into GIS so that we can perform some analytics on it. We can have information at our fingertips. So this example here is showing a project on the ICC, and so it can quickly give us a snapshot of who is the project manager, the timelines that we have for this project, the locations, obviously, and then we can pull up multiple projects just to see, if there's conflicts or how we look in a particular year in the location of projects. So we have more than 220 projects loaded into the system at this time, and we're still building this out in terms of dashboards and summaries. But the picture at the bottom right there is a dashboard, a quick summary of projects in different various phases, and with information that we can quickly move around and visualize our projects and the information about those projects. On our next slide, we have the criticality initiative. This is something that TSO had pushed. So we were working on establishing criticality frameworks for our structures, tunnels, pavements, facilities, our fleet, and our IT asset groups. And so essentially, we are looking at the criticality for those asset classes, and the criticality is defined as, what is the consequence of losing that asset failing. So obviously, we need the condition of our assets to do that. Criticality looks at a number of the effects and what goes into those assets, and then it uses this risk to tell us what that consequence is. And so we are working with our TSO partners to perform this so that we're in line with the rest of MDOT, and we can all report out and develop our criticality in the same manner. And so we're on our next slide, we have an example of the fleet criticality dashboard that we created for fleet. And this again would report up through to TSO, but essentially it allows our fleet folks to visualize their data they can look at it by which facility has which types of equipment, or they can look at it as MDTA as a whole, and they can tie in some of the financial information on those assets and have that quickly at their fingertips. So that's a little tool for our partners in fleet. Another effort underway within OEC is our contract submission effort, that is to take our data from our contractors that when they are creating or modifying, updating our assets in the field, we're asking and requiring them through the contract to submit the data back to us. So I talked previously about the efforts where we were going to the field, conditioning and inventorying assets. Now that we're establishing those, we are trying to close the loop on it and require that the contractors provide that data back to us. So we provide them the format that they need to report to us, and then as part of the contract submissions, they'll supply that data back to us. We'll QA, QC it, and update our assets with that information. So that's one of the efforts that we have underway for that. On our next slide, we have another effort, which is life cycle planning. So we are trying to take an informed approach about managing these assets. So we have this life cycle that we want to understand, and use analytics to help inform our project decisions. So we want to establish service life and replacement costs for all of our assets. And that way, when we're looking at projects, we can make decisions about the most efficient way to group the needs, weigh the criticality, and plan for that life cycle replacement. So this particular example happens to be for a generator and at a building, and so we are able to view those, and we can see, in this we have an average age against the expected life. So we are starting to build those for each of our assets so that we can again apply that to our capital programming. And then with that, we can move to the last slide and sort of touch on what's next. So as our data is maturing, we can look at higher level models. So we're looking at climate change vulnerability or resiliency, and modeling that and applying that to our projects. We're performing a business risk exposure, again, sort of that criticality assessment. We're rolling out the GIS viewer to replace the Google Earth so that the users in the field and other users throughout MDTA can have access to a lot more data, updated data. And then most of the effort that we've undertaken so far in the 2 years that we've had this discipline was to lay the groundwork and to pilot applications. And so moving forward, we'll be expanding that through each of our disciplines. And so we're looking at integrating our GIS with other existing systems. So our structures system already has an ACER platform. We're looking to integrate our GIS with that platform to continue the asset management in structures. And then our operations utilizes Maximo for their maintenance management system. And so we're looking to integrate our GIS with that so that the systems are all talking to each other, sharing data, sharing information, and then performing analysis as necessary. And then I guess the last thing would be, discipline specific. So within OEC, just starting to plan and build out asset management as a system for each of those disciplines and the assets for which they're responsible. So that was my presentation and my update for you on asset management in OEC.
Wow, that's a lot. It's amazing. I just find it very interesting, and I guess you have to scale it down a little bit, right? I mean, otherwise you'll never end. It'll never end. You have to select the most important items, I guess, to put in the database. But a lot of the information over the years has been there, but this is now we're feeding it in more rapidly and all that. How do we stack up in the with our colleagues around the different states with this? It seems to me we're being very proactive here.
Yeah, it's really exciting what we've been able to do in a relatively short time, the 2 years, and we've really sort of laid that groundwork to be really successful moving forward in terms of our efforts to integrate our data with our management system. So that's a key to us, is to, as OEC, we have responsibilities for our assets, but we share those responsibilities with operations, and having the two systems integrate is a key to really driving the success of this. As you said, there's a lot of data, so you got to kind of figure out exactly how deep down you go. But when we're properly maintaining these systems, we really do need to dig pretty deeply. So there is a lot of data that we need to get into the system. And then in terms of how we stack up pretty favorably. So there are some states that have accelerated in asset management, for a number of years, but none of those, they each have their struggles. So I think our struggle was tying us all together. So we're trying to unify all of operations and OEC into a cohesive system that's integrated. And once we are able to do that, I think we're going to be, well positioned to really mature and reach the higher levels of a mature asset management system that's really tying in the financials along with the your normal inventory conditioning, and then of course closing the loop on that is always important. So getting feedback from the contractors that touch the assets and operations when they're touching the assets, and that's some of the things we're working for.
Great.
So
I just want to say one more thing, if I can remember. My notepad here shows I have 10% left on my battery, and I apologize for that. It was charged, but I have to, if I get cut off, I'd ask somebody to close the meeting for me, if that's okay, if that's appropriate. But anyway, I'm sorry to interrupt you. Go ahead.
So I guess we'll make it a quick question, but I imagine we use a fair amount of tools, cameras, drones, sensors, and so forth for our asset management and in our maintenance and so forth. Is that linked to this system? Is that information getting fed automatically into this system?
So, I mean, it's not automatically fed into the system, and we're dealing with, so we have an inspection program, for our structures, a very robust program for our structures. So we're building the we're building out the other inspection programs, right? So we've had this structure inspection program in place. We're putting facilities inspection, program in place and traffic. So they're all utilizing tools, and I guess the biggest tool is this mobile feature. So the fact that you can do this while you're in the field helps efficiently collect this data. But when we utilize something like a UAS, a drone, that information is going to reside as a tag to an asset. It's going to be part of the record. And of course, all of that is to say we're still working on the IT side to be able to manage all this data, right? So when you start collecting, high resolution videos and photos of assets or LiDAR models of assets, it becomes, how do you manage all that data in addition to extracting the key pieces? So that's part of what we're working on as well.
Great. Thank you.
Thank you. Are there any other questions? Okay. some good discussion here. And Jim, thank you for your presentation, and thanks for all the work you do for MDTA. So
Sure.
we appreciate it very much.
My pleasure.
That is everything we have on the agenda today. And I just want to also extend a thank you to everyone who behind the scenes helps with these presentations, those who presented and those behind the scenes who have helped with the preparing of these presentations and help keep us straight on things and communicate things, Ebony and Natalie and others. We appreciate it very much, and we thank you for that. So there's nothing else here on the agenda. Is there a motion to adjourn?
So moved. Member Carroll?
Yes. Okay, second?
Second.
Member Arndinger, I'll second.
Okay, all in favor?
Aye.
Aye.
Okay, we are adjourned. Thank you very much.
Have a great day.
Bye, everybody.